Hi, I'm Steve LaFrance with Blakely Financial. The first quarter's in the books, and stocks continued their upward trajectory with the S&P returning more than 10% for a second consecutive quarter, setting 22 new all-time highs along the way. The previous market high in January 22 was just prior to when the Fed began hiking rates to tackle the post-pandemic spike in inflation. Then the market sold off as investors feared the worst before realizing the economy wasn't going to break. Part of the driving force for the market's recent performance has been inflation's steady downward trend and the expectation it will continue moving lower. As I pointed out last month, this expectation is now being challenged as the data seems to be trending sideways, or technically, drifting lower at a much slower pace. The question is whether the slowing progress is the start of a new trend or a temporary break in the current trend. Seasonality and recent increases in oil prices may prolong the achievement of the Fed's 2% inflation target. This helps explain why the markets dialed back their expectations from 6 rate cuts this year to just 3. Another reason is that the U.S. economy has remained resilient. Home construction activity is now currently at levels not seen since before the 2008 financial crisis, despite the higher mortgage rates. Consumer sentiment rose to a 2.5-year high after setting a record low in June 22 due to multiple factors such as a tight labor market, expectations for a continued decline in inflation, and a solid economic backdrop. And while this may be counterintuitive, the recent rise in crude oil prices suggests demand is strong and hints at the underlying strength in the U.S. economy. We already covered how the S&P has been hitting new highs, but what about the rest of the markets? Broadly speaking, everything else has been underperforming the S&P. Small caps returned 5%, international returned 6%, and emerging markets returned 2.2%. The outperformance of the S&P has persisted for several quarters, mostly due to the U.S. economy's continued expansion and exposure to artificial intelligence companies. Bonds are slightly negative through Q1 after finishing 2023 strong, and this is mostly due to the change in expectations for rate cuts. The big investment themes were mostly unchanged during the first quarter. Stocks traded higher, unemployment remains below 4%, the U.S. economy expanded, and we're expecting fewer rate cuts. Economic theory suggests these higher rates should slow economic activity as the cost of capital increases, but the data tells a different story this cycle. It's difficult to overstate the uniqueness of our situation. There was unprecedented monetary and fiscal stimulus in 20 and 21. Followed by a rapid rise in rates in 22 and 23 as inflation reached levels not seen since the 70s. In the housing market, homeowners locked in low mortgage rates, which has effectively limited the impact of rising interest rates. The labor market remains relatively tight after 5 million workers left the labor force during the pandemic and didn't return, which has never been seen before. And these themes will not reverse quickly and will have long-lasting impacts, which both the Fed and the markets must continue to navigate. That's all for right now. Take care of yourselves, and thanks again for your trust and confidence.